The total global output is significantly higher than before the pandemic hit in late 2019. It is anticipated that this year, or perhaps even the previous year, the world will achieve a GDP of $100 trillion for the first time in history. This means that the world is producing 3 times more than it did just 23 years ago at the turn of the millennium. During this time, the global population has increased by 2 billion people, which represents a growth of around 30%. Consequently, the average person today is twice as economically prosperous as a generation ago. It is important to note that while prosperity has not been distributed equally, the overall quality of life for the average person has improved. Despite growing inequality as the world gets richer, economists generally agree that this trend of improvement will continue. While the global economy is thriving, there is a concerning trend of individual economies experiencing isolated breakdowns. These breakdowns pose a threat to the economic output in these countries largely consists of informal labor and subsistence living, with individuals producing their own food, shelter, and providing services within small communities. Consequently, their economic activities are not formally recorded in national economic output figures. Advanced economies also experience a similar phenomenon on a smaller scale. For instance, if you clean your own home, it does not contribute to economic output. However, if you clean someone else's home and get paid for it, that service is counted as part of the GDP. In developing and advanced economies, a significant portion of people's labor is dedicated to producing output for the market. This specialization allows individuals to excel in their respective tasks and contribute to overall economic growth. However, it also makes people more dependent on the market and less self-sufficient compared to undeveloped economies. This dependency on the market creates vulnerabilities in the event of an economic downturn. On the other hand, advanced economies possess several advantages that make outright collapses less common. These economies have industries that provide valuable goods and services globally, ensuring a consistent and reliable source of foreign income. Additionally, their high standards of living make them attractive destinations for skilled workers worldwide. They can easily address skill shortages by offering working visas to attract skilled professionals who seek higher salaries and better living standards. In times of economic downturn, unemployment in advanced economies can self-correct as individuals may return to their home countries, thereby reducing the unemployment burden. Furthermore, advanced economies have the advantage of borrowing money at lower interest rates, often from their own populations. They can even borrow in their own currencies, avoiding issues with foreign exchange rates and the need to source foreign currencies for loan repayment. In contrast, many economic collapses in developing countries have been triggered by temporary disruptions in their access to US dollars, either due to trade slowdowns or the withdrawal of investments by US-based institutions. The current global scenario is witnessing such economic challenges as interest rates rise and uncertainty about the future intensifies. Developing economies, in particular, are vulnerable to external shocks and face difficulties in managing their economies effectively. Factors such as weak governance, political instability, corruption, inadequate infrastructure, and limited access to capital markets contribute to their susceptibility to economic breakdowns. Uncertain about the economic future of many weakened countries, multinational corporations face a dilemma. Should they take the risk of investing their money in developing nations that have the potential to become the next Sri Lanka? Or should they opt for safer investments like government treasuries that offer high yields without the associated risk? This situation also puts pressure on developing economies as their governments must offer even higher interest rates on government bonds to compensate investors for the risk of not choosing domestic treasuries, where repayment is almost guaranteed. For example, Sri Lanka currently pays a staggering 24.4% interest on their 10-year government bonds, and yet even that is insufficient to attract most investors. This issue is of utmost importance as it undermines the role of governments in driving economic growth. Strong and effective governance is crucial for any economy, and one of the critical roles played by governments is to provide the necessary infrastructure for industries to thrive. This infrastructure includes shipping ports, airports, roads, phone and internet networks, and even education and healthcare systems. Without these utilities, industries would struggle to operate competitively. Take, for instance, a company like Amazon, which relies on ports, roadways, and internet infrastructure to transport and manage its products worldwide. Moreover, a skilled and educated workforce is essential for building and sustaining industries. Investing in infrastructure that facilitates industrial growth is vital for the overall economy. Although some utilities can be eventually privatized, it is initially the responsibility of governments to build them. Well-planned infrastructure spending should stimulate economic growth, generating additional tax revenue from industrial activities that can be used to repay the loans taken out to fund the infrastructure projects in the first place. However, in the real world, most governments cannot simply print their own money to fund these projects. They often engage with big international companies that prefer payment in a world reserve currency such as the US dollar, euro, or increasingly, the Chinese renminbi, RMB, when Chinese construction companies are involved. Developing countries face challenges in building infrastructure from scratch and attracting investments that require stable currencies. In contrast, advanced economies have significant advantages because much of their infrastructure is already established. While they require reinvestment, expansion, and maintenance, it is still much easier, cheaper, and less risky than building from the ground up. Another advantage enjoyed by advanced economies is their ability to borrow money at lower interest rates. For example, a 10-year U.S. federal bond currently has a yield of 3.43%. Although investing in projects that stimulate significant economic growth is challenging, it is feasible for countries like Sri Lanka. However, no nation-building project can guarantee a 24.4% contribution to total economic activity every year. Therefore, it does not make sense for an economy to solely rely on such projects for development. Additionally, it assumes that investments are well directed towards projects that promote economic activity within the nation, rather than being merely symbolic gestures to boost the ego of a dictator. Over the past decade, China has been a major source of foreign investment in developing countries through its Belt and Road Initiative. China provided cheap loans to build infrastructure projects that would integrate these nations into its expanding trade network. While developing countries were eager to participate, the catch was that China expected the loans to be repaid, even at low interest rates. Furthermore, China had significant control over the type of infrastructure projects that were constructed, favoring those that would enhance trade with China. For instance, a shipping port was more likely to be built over an electrical grid, even if the latter would have been a better economic investment. Uncertain about the economic future of many weakened countries, why would a major multinational corporation take the risk of investing in a developing nation that could potentially roadways, and internet infrastructure to transport products worldwide and run its operations smoothly. Additionally, a skilled and educated workforce is required to build and sustain these facilities. Investing in infrastructure that supports the existence of industries is crucial for any economy. Although some of these utilities can eventually be privatized, initially, it is the responsibility of the government to build them. Spending on infrastructure should lead to sufficient economic growth, generating additional tax revenue from industrial activities that, in turn, repays the government's loans used to fund the infrastructure. Unfortunately, in the real world, most governments cannot simply print their own money to finance these projects, especially when dealing with large international companies that prefer world reserve currencies such as the US dollar, euro, or increasingly, the Chinese RMB if it involves a Chinese construction company overseeing the development. It's important to remember this aspect, and we will delve into it shortly. Advanced economies have significant advantages over developing economies in this regard because much of their infrastructure is already built. Additionally, advanced economies benefit from lower interest rates when borrowing money. For instance, a 10-year U.S. federal bond has a yield of 3.43% at the time of making this video. Although it is challenging, it is feasible for a country like Sri Lanka to invest in projects that will stimulate economic growth equivalent to or greater than the interest rates they need to pay. However, there is almost no nation-building project that can contribute 24.4% of its cost to total economic activity every year, which makes it economically illogical for a country to develop itself. In conclusion, developing economies face complex challenges in building infrastructure and fostering economic growth. The slow and steady approach of representative democracies ensures accountability, but can lead to delays. Meanwhile, governments with no direct accountability may prioritize quick implementation over careful planning. External factors like economic shocks further strain these economies. Nevertheless, strong government institutions and strategic investments remain crucial for sustainable development. Thank you for your support. Don't forget to subscribe and like our videos for more insightful content on economics and global development.